6.6% locked in with a Dow Chemical corporate bond? Might this be something to consider? Hello everyone, and welcome back to Markets with Marcus. So, in our VIP investment club, our members often share bonds, CDs, and other investment ideas that they find attractive with each other. One name that has come up more often recently and been a part of some lively VIP member discussions is Dow Chemical. Dow Chemical often shows the highest yields on Fidelity's new issue page for corporate notes, and if you go on the secondary market, they offer bonds that allow you to lock in potentially attractive rates for the long term. For example, this Dow Chemical note here has a yield to maturity of 6.601%. The yield to worst is almost identical at 6.599%, and the first call date is in November 2052, basically 26 years into the future from the time of this taping, on May 3rd, 2026. But of course, as our Diamond NestEgg regulars know, it's always higher risk, higher return in money and investing. And Dow Chemical is a complicated name. So, with that in mind, here are the three topics that we'll be covering today. 1. Who is Dow Chemical? And what may make their bonds attractive? 2. Why are Dow Chemical bonds paying such high yields? And what are the risks? And 3. What's our personal opinion? Let's get started. Who is Dow Chemical? And what may make their bonds attractive? Dow Chemical is one of the big names in US industrial history. It was founded in 1897 in Midland, Michigan, and grew into a global giant by investing heavily in research and new products. For example, the company invented Styrofoam. To make a long story short though, after a series of acquisitions, mergers and split-ups, Dow Chemical doesn't own the trademark to Styrofoam anymore. It's now held by DuPont. These days, Dow Chemical is still a leading global material sciences company, but it focuses on the more or less invisible things that we often take for granted. And please note that for purposes of this video, we will use Dow as a shorthand for both Dow Inc., the listed parent company, and the Dow Chemical Company, basically its only operating subsidiary that is also the issuer of most bonds. Roughly half of Dow's business is packaging and specialty plastics, while the rest is divided between industrial intermediates and infrastructure, things like construction chemicals, and performance materials and coatings, including chemicals that go into paints and electronics. Sales are split roughly equally across the US, Europe, the Middle East, Africa and India, and the rest of the world, as you can see here. So, what would speak for potential investment in a Dow bond? Well, there are three arguments that may be in favor of investing in a Dow bond. The first, and probably most important one, is that the potential return may look attractive in today's market. Remember, this Dow bond has a yield to maturity of 6.601% and a yield to worst of 6.599%, when comparable 20 and 30-year treasuries pay around or even a bit less than 5%. Plus, with a coupon of 6.9%, you may expect a decent interest payment every 6 months in cash, even though the bond is currently trading at a slight premium. Second, you may be able to find a Dow bond that is basically not callable. Many, if not most new corporate bond issues seem to be callable these days. So the fact that this older bond from Dow that we've been discussing is not callable before November 2052 may allow you to lock in the 6.6% yield for the long term, if that's what you want. These two Dow bonds down here have similar yields to maturity and yields to worst, and are also only callable 6 months before maturity, bringing us to reason 3. Dow has a reasonably large offering on the market as an issuer. Fidelity shows 81 bonds in its secondary market database. And at least this Dow bond that we've been discussing before shows a relatively narrow bid-ask spread of 103.423 versus 103.742, and small minimum amounts of $2,000 for both sides, meaning you should be able to either buy or sell this bond even in smaller retail amounts at a more or less reasonable price at the time of this taping. So, in a nutshell, the main reason why Dow bonds have been coming up more often recently in our VIP investment club is that they offer potentially attractive yields, may allow you to lock in some rates for the long term, and are perhaps reasonably liquid and available on the secondary market for retail investors even in smaller amounts. And if you'd like to come join the daily conversations in our private VIP investment club to see what other potentially attractive rates and investment opportunities me, Chen, and our VIP investment club members are talking about right now, visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below for your convenience. The way we see it, it never hurts to have a reputable second or third pair of eyes and ears that you trust to bounce ideas off of. Back to these Dow bonds now. Please keep in mind that all the numbers in today's video are as of the time of this taping, on May 3rd, 2026, and may change at any time. Always check for the latest updates whenever you are watching this video. Also, all the screenshots shown today are for illustration purposes only and do not constitute an offer to buy or sell or guarantee any rates or conditions. Past performance is not indicative of future results and outcomes. Now that we've covered the three arguments that may be in favor of investing in a Dow bond, let's move on to the flip side of the coin. Why are Dow Chemical bonds paying such high yields? And what are the risks? Let's start with the key issue. Dow has not been profitable for a while. After showing a net loss of $2.6 billion in 2025, Dow just lost another $533 million in the first quarter of 2026. Now, Dow operates in a very competitive industry that doesn't make life easy for any of its global competitors either. But it has to solve several strategic headaches of its own making on top. Let's just pick two of them as examples. Example 1. Dow owns 35% of Sadara, a joint venture with Saudi Aramco that operates one of the world's largest integrated petrochemical production complexes on the east coast of Saudi Arabia. From the beginning, Sadara has never been profitable. Dow had to write down its investment to basically zero, and Dow remains on the hook for some of Sadara's project finance debt that it guarantees. And to make things worse, no one knows how the ongoing war with Iran and the closure of the Strait of Hormuz will impact Sadara in the long run. Example 2. As part of what it calls Path to Zero, its commitment to be carbon neutral by 2050, Dow is currently investing several $billion into building the world's first net zero ethylene cracker and derivatives facility in Canada. However, the project has been progressing more slowly than planned, and Dow now expects to complete construction of the project with a 2-year delay, with the first and second phases expected to start up by the end of 2029 and 2030, respectively. This means that even if everything now proceeds as planned going forward, the project will only start to generate cash flow and hopefully profits in about 3.5 years from the time of this taping. As a consequence of all these challenges, both Standard & Poor's and Moody's downgraded Dow Chemical's long-term credit rating in February. It now stands at BBB- and Baa3 respectively, which are the lowest investment grade ratings on both their scales. Moreover, both S&P and Moody's kept their outlook at negative, indicating that further downgrades might follow, which, if that were to happen, would bring Dow into non-investment grade or junk territory. The only good news here, if you want, is that a few weeks after the S&P and Moody's downgrades, on March 16th, Fitch, the third of the big three agencies, affirmed Dow's rating as BBB and its outlook as stable. So it appears the opinion may still be out on Dow, bringing us neatly to the next section of today's discussion. What's our personal opinion? So, with everything that we've just discussed, we are not huge fans of Dow for safety-conscious, investment-grade bond investors. As many of our Diamond NestEgg regulars know, we prioritize safety, stability, and predictability in our fixed income investments, and leave the growth and risk-taking to the non-fixed income part of our portfolio. So we don't own any Dow bonds in our personal portfolio. However, everyone's financial journey is different, as we always say. For example, let's take our Diamond NestEgg base and boost strategy, which we'll be talking more about in the coming weeks and months. If you've built your base of safe annuities, treasuries, agencies, and other types of highly rated bonds, and you're thinking about the part of your portfolio that you want to boost, then you may approach Dow with a more risk-taking mindset. And if you're not afraid of a potential downgrade to non-investment grade/junk ratings, you might decide that these yields are worth the extra risk. At least the stock market may seem to support a more upbeat perspective. At the time of this taping, on May 3rd, 2026, Dow's share price is up 72% for the year. This performance is significantly better than two ETFs that track Dow's peer group of global material sciences companies. iShares Global Materials ETF, ticker MXI, the yellow line here, is only up 13% over the same period. And for State Street's Materials Selector Spider ETF, ticker XLB, the light blue line here, it's 10%. Dow's management was also reasonably upbeat in their earnings call on April 23rd. They phrased it in a very corporate way, but they seem to think that all the restructuring that they have started, what they call self-help actions here, is starting to bear some fruit, not just in terms of cost savings, but also in getting the risks from both Sadara and Path to Zero slowly under control. Plus, and maybe more importantly in the near term, Dow seems to see themselves as a big winner of the current crisis in the Middle East. With competitors potentially disrupted and oil remaining expensive, Dow should benefit from their North American footprint, which is far away from the Middle East and has easier access to local oil. As their chief operating officer expresses it, "What I can say is that our prices around the world are going up." Please don't forget that rating agencies and equity markets look at Dow from different perspectives. Ratings agencies have in mind that you want your principal back when a bond matures, so they work with long-term perspectives and prioritize stability and predictability. The stock market, on the other hand, can often be more fickle and volatile, as it tries to predict potential future gains for the share price. But neither can really predict the future, just as past performance is no indicator of future results and outcomes. So, what is it for you? Are you avoiding Dow and sticking to more conservative bonds? Or are you tempted to dip your toes into the water with some Dow bonds as part of an overall diversified portfolio? Or might you even be considering some Dow shares? Leave a comment below and let me, Jen, and the rest of our Diamond NestEgg community know. Or come join our VIP investment club to continue learning about the best rates, investment opportunities, and what others like yourself in our growing member community are doing right now for safety, as well as for higher yielding growth. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. And if you plan on picking up some Dow bonds, remember that if you buy on the secondary market, there will typically be a fee of $1 per $1,000 par value with the leading brokers, including Fidelity, Schwab, and Vanguard. Thanks for watching and see you again soon.